Current assets are assets which have a life of more than 1 year. Okay, so these are those assets. Now, what are some of the examples of non-current assets? This can be vehicles, there can be plant and machinery, there can be land, land and building, there can be equipment, and some others as well. So these are basically your non-current assets. And for non-current assets, we charge depreciation for non-current assets. Now, what is depreciation? Depreciation is basically an expense that we charge to account for the wear and tear of any non-current asset. You see, when you use assets, their condition starts getting worse as time progresses. Or maybe if it is a technological asset, like for example, if it is a computer, then the technology may start becoming obsolete. So those sorts of things, to account for those sorts of things, we charge depreciation. Are you with me, Zan? Is this clear? The concept of depreciation.
Yes, the depreciation is when we charge for the equipment that can be useless after a year, or it's being deteriorating after the years.
Your voice just cut off, Zan. Sorry. What were you saying?
Depreciation is the use of products that are getting worse after time.
Yeah, first of all, don't use products, use non-current assets. Products are not non-current assets.
Okay,
Okay,
sir.
we're talking about non-current assets when we're talking about depreciation. And it is very simple. Like, for example, if you have a new car, if you just go and buy a new car, the car will be worth some amount, for example, $20,000. But a year from now, when you have used the car, it will not be worth $20,000 anymore. It will be worth less. And the next year after that, when you've used it for one more year, it will be worth even less. So that basically the amount that it is reducing in value by, we call that depreciation. Okay.
Okay, sir.
So there are certain causes of depreciation. So like we discussed, there can be wear and tear, there can be obsoleteness. There, when it comes to land, in fact, we don't actually have to do that. So yeah, and there can also be, of course, when we talk about buildings, yeah, that will come under wear and tear. Okay, so let's now talk about the methods of calculating depreciation. So first of all, we have this straight line method. Then we have the reducing balance method, and then we have the revaluation method. So there are these three methods to calculate the depreciation, and these are all very simple. We'll begin with the straight line method. In the straight line method, the same amount is charged as depreciation for the whole useful life of the non-current asset. Okay, so for example, if the asset is having a life of 5 years, all this will be told to you in the question. So if the asset's useful life is of 5 years, the depreciation charge for every single year will be, for example, 10,000, and it will stay the same until the fifth year. So this is what the straight line depreciation means. How we calculate it is also very, very simple. Formula for straight line depreciation is to calculate the depreciation per year. What you need to do is you need to take the cost of the asset. You have to subtract the residual value from the cost. This will all be given, and you need to divide that whole thing by the useful economic life of the asset. Now let's talk about each of these things: cost, residual value, and useful economic life. So cost. Cost is the total cost at which the asset was bought. Are you with me then so far?
Yes, sir.
Yeah. So cost is basically just the cost, the total cost for which you bought the asset, whenever you bought the asset. The residual value is also called the salvage value. It can also be called scrap value. All these terms, they mean the same thing. Okay, now what exactly is the residual value? This is basically the value the value that the asset might carry at the end or at the end of its useful life. Okay. And again, the useful economic life, all these things will be given to you. Useful economic life is just the total life of the asset. Now let's do a few examples for the straight line method. For example, you get a question which tells you that XYZ Corp bought a car for $100,000, which has a useful life.
So I have a question.
Yes, yes.
I didn't understand the economic life value.
Economic life then will always be given to you. It is always estimated. What happens is when we're talking about companies, they have different valuers. There are very big companies who value the assets and the life of assets for different companies. Okay. Now, whenever you're buying any asset, uh, obviously historically, if we're talking about big companies, if they buy a new car, they already might have bought like thousands of cars before as well. So they would know that a car will last them around 6 to 7 years, for example, right? They would know that after 6 years they usually have to sell the cars because they maybe their engines need to get overhauled, or their bodies are in a very bad condition after 5 to 6 years. So this is sort of the estimation. The useful economic life is the estimation which is done by accountants on day one when they buy the asset, that this particular asset might last us for about 5 years, and then we may have to sell it, or we may have to replace it. Okay, that's all it is. You will not have to estimate the useful life ever. The useful economic life will always be given to you in the question. Even if you get to the master's level in accounting, you will always be given the useful economic life.
Okay, sir.
Okay, good. Okay, so XYZ Corp bought a car for $100,000, which has a useful life of 5 years, and a residual value of, let's say, how much can we say? Let's say $20,000. $20,000. And your question is calculate the, in fact, your question is, in fact, let's just start with the basic one. Calculate the depreciation using straight line method. Now it's very simple. The solution for this, we will do the formula for straight line depreciation is cost minus, I'm writing SV for scrap value or salvage value or residual value, divided by economic life. So the cost for our car was 100,000. Our scrap value was 20,000. And our economic life was 5 years. That's 80,000 divided by 5, which is equal to $16,000. This is your depreciation for 1 year. Okay. And now, as we discussed for straight line method, the depreciation remains the same for all the years. So we know that we have this asset for 5 years. So every single year, the depreciation would be $16,000. Are you with me so far, Zan?
Yes, sir.
Okay. So now let's look at the logic behind all of this. All right. We actually have to make sure that the cost at the end of the economic life the depreciation amounts to the whole cost of the depreciation. And let me do this with this example so that you'll be able to better understand. So at the end of year one, our total depreciation charge was 16,000. Is that correct?
Yes, sir.
Right? At the end of year one, we charged just this. There was no 2, 3, 4, or 5. There was only one. So the total charge was 16,000. But at the end of year two, we charged another 16,000. Right? So our total was 32,000 at the end of year two. Right? We charged 16,000 in the first year, then 16,000 in the second year, and then we had a total depreciation charge on that particular car for 32,000. Does that make sense?
Yes, sir.
Yeah. Then for third year, we charged another 16,000. When we add that into the previously charged, it would become 48,000. Then at the end of year four, we charged another 16,000. So we had 64,000. And at the end of year five, we charged another 16,000. So we had a total of $80,000 here. This is the total depreciation charged until year five. Okay. This total depreciation charged until year five, we can also call this accumulated depreciation. Accumulated means total, and depreciation is depreciation. Okay, we will come across this concept a little later today. But this accumulated depreciation is just another name for total depreciation that has been charged up until this time. Now, we have charged a total of $80,000. And remember, we had a scrap value of $20,000 for this car. And if you add the scrap value to the total depreciation charge at the end of the period, you will always end up with the total cost that you paid for the depreciation. This is just for logical purposes, just so you know what just happened. We actually moved in a backward sequence, right? You will
Yes.
always be asked to calculate the depreciation which you did. But does this make sense, what we just did?
Yes, sir.
Yeah. Now, another thing about scrap values is that it is basically sort of what you think you will be able to sell the asset for after the end of its useful life. All right. So, for example, you bought this car for $100,000, and you think that okay, after 5 years is the life, and I think I will be able to sell this car for $20,000 after the end of its useful life, right? So the remaining amount, that is $80,000 when you deduct that amount, because you will be able to recover the 20,000 when you sell that car, right, from the cost. So the remaining $80,000 you charge, you allocate those $80,000 that you paid today over the whole of the useful life of the asset. Does that make sense? Does this logic make sense?
So like the total depreciation and the scrap value when you add should cost to the total cost of the product we bought it.
Yeah. This is one logic. Another logic is then that, for example, another way to think about it, this is just, you don't have to get confused. You are absolute, the way that you just described it, that is absolutely right. But this is another way to look at it as well. So for example, this is 2010. You're in 2010, right? And you buy an asset for $100,000, right? Now, you're going to use this asset for the next 5 years, like we discussed in our example. You're going to use this asset for the next 5 years. Now, for example, if you bought this asset for 100,000 in 2010, and you're making your income statement for 2010, when you're making your income statement for 2010, in your expenses section, first of all, in income statement, you write your incomes, all the incomes that you had. Then you write your expenses, all the expenses that you had, and then you arrive at then you obviously you have your incomes, then you subtract your expenses from those incomes, and at the end you arrive at a figure for your profit. So this is what an income statement is. We will get to that. This is very simple and basic. Anyway, the thing is that this is sort of an expense, right? This 100,000 that you just spent, this is sort of an expense. Now, considering that you're going to use this for the next 5 years, it does not make sense that you charge the whole $100,000 on the in or as an expense on the incomes of just 1 year, right? This is income statement for just 2010. So what you do is you divide this cost over the useful life. You divide the cost of the asset over its useful life to write it as an expense in the appropriate period, right? For example, out of this 100,000, out of this 100,000, you already know, okay, you are going to get back 20,000. So that is good. You are remained with $80,000 of money that you spent. Now this $80,000, you're going to get the benefit of this $80,000 for the next 5 years, right? So for year one, you will subtract 16,000 from your incomes. For year two, you will also do the same. And for year 3, 4, and 5, and so on, you will use the same. Does this logic make sense, or is there any confusion?
Yes, sir.
Good, good. Okay. So this is all about the straight line method. This is actually more than the straight line method. This next logic will remain for every single depreciation method that we study. But the straight line method primarily is that you charge the same amount of depreciation every single year, and yeah, that's what straight line method. And the formula is you take the cost of the asset, you subtract the scrap value or the residual value or the salvage value, and then you divide that by the total useful life of the asset.
Sir, I have a question.
Okay.
Sir, when the question
Yes,
comes,
yes.
do we know which method we have to use, or we have to understand the method we have to use?
99% of the cases, 95% of the times, you will be given uh, the the method that you need to use. Sometimes the question will be very basic, that they will give you a percentage and they will say, okay, you are supposed to charge this percentage as depreciation, and then you assume it to be straight line method. But 95, in fact 99% of the times, you will be given that what method you need to use, and it will 99.9% of the times it will be one of two methods, either straight line method or the reducing balance method.
Okay, sir.
Okay. Now sometimes they might also ask you to create a depreciation schedule. I'll get to the reducing balance method in a while. Let's just get done with the depreciation schedule. This is very simple again. And this is basically how you will charge the depreciation. This basically tells how the depreciation expense will be allocated over the useful life of the asset. So what we have done over here, right? All of this stuff that we've done, this stuff and uh, this stuff, all of this, when you do it in sort of like a good format, a good looking format, that is what we call a depreciation schedule. So let's do that for the example that we did for the car. It is very simple. You write your years like this: year one, year two, year three, year four, and year five. Then you write the original cost, which for us was 100,000. The original cost will stay the same because on year four, even if on year four you go and you look at the books, it will still say that you paid $100,000 for that particular car. After that, you write your accumulated. Accumulated is the total depreciation. Accumulated depreciation. Accumulated means total. Okay, when you leave this line, then you move further down where you write the opening balance. Then you write the depreciation for the year. Depreciation for the year. And after that, you write the depreciation carried down or closing. This was accumulated depreciation opening. And then you write the final thing, which is the carrying value or the net book value. Okay. So this is the format that we use for the depreciation schedule. And you will have to sort of learn this. Very rarely will you come across a question which will ask you to create a depreciation schedule. But if you come across it, you need to understand. Actually, you need to understand what you're doing, and then you can shift a few things here and there, and you will still get full marks. But the thing is that the logic should be clear. For example, in our case, just give me 1 second. Okay, perfect. So the original cost of the asset was $100,000. Is that clear then? The original cost of the asset was 100,000,
Yeah.
right? The accumulated depreciation opening. So we always charge depreciation at the end of the accounting period. Okay, so for example, it will be charged at the end of 12 months, or if we're preparing our books for 3 months, it will be charged at the end of those 3 years, not at the start. So at the start of year one, our accumulated depreciation will be zero. The opening balance of the asset would still be 100,000. Depreciation for the year, as we calculated using straight line method, it was 100,000 minus 20,000, which was scrap value, divided by 5. So our depreciation came out to be 16,000. So we will write 16,000 here. And then accumulated depreciation carried down. Now, the accumulated means total. Now, at the closing means at the end. So at the end of year one, the total depreciation charge is 16,000. Right? The carrying value is very simple. Carrying value or net book value or carrying value is cost minus accumulated depreciation. When you subtract the total depreciation charged from the cost, you get the net book value.
Sir,
So
from
you had the opening.
the
Yes, yes.
balance brought forward value.
Sorry.
Sir, you said so we will take the carry down value or the brought forward balance brought forward value.
No, you will always take the carry down value. You will always consider the carry down value, the value that is at the end of the accounting period, the closing value. Okay.
Okay, sir.
Yeah. So 100,000 minus the total that you have charged so far is 16,000. So you end up with 84,000. Yes. The carrying value is 84,000 at the end of year one. So at the start of year one, you had 100,000, then you use the asset for 1 year, you charge the depreciation for 16,000. At the end of that 1 year, you are left with 84,000. Now for the second year, this accumulated depreciation carried down will become the accumulated depreciation brought down for the second year, right? At the end of year one, total was this. So at the start of year two, the total would be the same as the end of year one, right? That makes sense.
Yes, sir.
So this accumulated depreciation carried down will go here. Again, the opening balance now, this was the carrying value was the closing balance at the last year. This will become the opening balance of first year, which is 84,000. Depreciation for the year, as this is the straight line method, would still be the same. 16. We can just write it right now. It will stay the same. 16,000 as we're using the straight line method. Okay, so 84,000 was the carrying value. You subtract here now. In this case, then we had our charge for this year's depreciation is 16,000, and we already have an opening of 16,000 here. So 16 plus 16, the total charge by the end of year two, we're talking about year two, our total charge has been 32,000. Right? And the carrying value will be 100,000 minus 32,000, which will be 78,000, 68,000. Are we clear, sir?
Yes.
Yeah. Now again, the 68,000 will become the opening. The 32,000 accumulated depreciation closing for year two will be opening for year one. The closing carrying value for year two will be the opening for year three. And then again, when we subtract 16,000 for this year's depreciation from 68,000, we get 52,000, which will be the carrying value. Now 32,000 plus 48,000 will come here. Now again, this 52,000, which is the carrying value at the end of year four. Year three will be the starting value at the end of year four. And when we subtract 16,000 from 52,000, we are left with 42 minus 6, 36,000. And our total depreciation now has become, this was 52, yeah. We'll move this 48,000 here. 48,000 plus 16,000 that we have charged this year would be 54,000. No, 64,000. Okay, and then we'll take this 36,000, move it right here, subtract the 16,000 from this 36,000 and end up with 20,000. At the end of year five, our total depreciation has been 80,000, carried down at the end of the year 64,000. And you see then at the end of this year five, we are left with the scrap value, which was already given to us in the question. Any confusions then regarding this table? Is it clear? Are you confused?
Yeah.
Yeah, clear or confused then? Couldn't hear you.
Sir, I'm clear. And written.
Good, good. Just go through the chapter of the book once we're done, right? Just read it quickly, give it a quick read, and you'll understand it better. Also, try to do all the examples that are in the chapters, in all the chapters. The past paper stuff, you don't need to worry about that at all, because if you work your way through all these examples, the past papers will be like a piece of cake. Okay. Okay, now let's talk about the reducing balance method. Reducing balance method is all very simple. The difference is that in this method, we charge depreciation on the net book value instead of the cost. It's very simple. Remember in the straight line method, we were using 100,000. We were multiplying it. We were sort of subtracting the scrap value from it. and we were dividing it by 5 to arrive at 16,000. And for year 2, we were doing the same thing, 100,000. This was year 1. Year 2, we were doing the same thing, minus 20,000 divided by 5, 16,000. Now, again, we were always using this cost to calculate the depreciation. For reducing balance method, we do it on the net book value. And what is the net book value? As we've discussed in the previous example, net book value, or NBV, is total cost of the asset minus accumulated depreciation. Okay, so for reducing balance method, the calculation is very simple. They always give you a percentage, right? So for example, let's do a quick example. They tell you that ABC Corp bought an asset for $55,000, right? And decided to charge 20% depreciation using the reducing balance method, right? So this is actually extremely simple. I'll just draw a table so that you're better able to understand. So for example, we have the years here. This example is also in your book. So year 1, 2, 0, 1, 2, 3, 4, 5. Okay, so you have the years here, then you have the cost, then you have the depreciation, then you have the total depreciation or accumulated depreciation, and then you have the net book value. And like we discussed before, this can also be called the carrying value. Okay, so we bought the asset for $55,000. The cost at the year 0 was 55,000. At year 1, the cost will always remain the same. Always remember. The cost at the start of every year will be the same because obviously you bought the asset for one price at the start of year 0. Now the depreciation in this case, for example, if we're supposed to do a little bit of a working on this side. So for year 1, the calculation would be, you will simply take the cost and you will multiply it by 20% to get the depreciation, right? Because the rate that we were given was 20%. The cost was $55,000. So 55,000 times 20% would be 11,000. And you will take this 11,000 and you will write that as depreciation for the year. Your accumulated depreciation, total depreciation that has been charged by the end of year 1 is 11,000 itself. And your net book value will be this cost minus this depreciation, total depreciation. See, total cost minus accumulated depreciation. So total cost minus accumulated depreciation. So you will be left with $44,000. Clear so far then?
Yes, sir, I'm clear.
Good, good. Now for year 2, this is also a depreciation schedule. See, you just need to understand the logic and you can make it any way you like. You can use the above method that we did or this method, whatever seems easy to you. So for year 2, again, the cost, yeah. So now depreciation for reducing balance method, where is it? Yeah. For reducing balance method, we charge it on the net book value and not the cost. Okay. So the net book value was 44,000. Right, 44,000 we multiplied by 20%. And we'll end up with 8,800 for this year. This is the charge for this year. We will write 8,800 here. Now the total depreciation at the end of year 2 would be this 11,000 plus this 8,800. So we will have 19,800 of accumulated depreciation. Then our net book value would be this 55,000 total cost minus 19,800. Our net book value will be 35,200. For year 3, again, we'll take the net book value, which is 35,200, multiply that by 20%, and arrive to 7040. This is our charge for the year. The total accumulated depreciation at the end of year 3 would be 7040 and 26840. And our net book value would be 55,000 minus 26840, which is 28160. Again, from year 4, we'll look at the net book value at the end of year 3, which was 28160 multiplied by 20%, get to 5632. And this will be our charge for the 4th year. Accumulated depreciation would now become 32472. And our net book value will be 55,000 cost minus 32472, which will be 22528. And then again, for the last year, we will take this 22528, multiply that by 20%, and get to 4506. This will be, for the last year, accumulated would become 36978. Our net book value will be remaining 1802 and 2. This is how we calculate reducing balance method. The difference between this and straight line method is very simple. If you look at here, then the depreciation in year 1 is higher than year 2. Then year 3 is lower than year 2. Year 4 is lower than year 3. And year 5, we charge the least amount of depreciation. For straight line, depreciation remains the same. For reducing balance, depreciation reduces over time. See, the name also suggests that. Reduces over time. Are we clear with this then? Any confusions?
Yes, sir. Sir, like in straight line, we used to like calculate the total. We used to like minus the total, put the accumulated carry down value, then plus the scrap value. Then we used to get the total cost. Then how do we know that in this one, this answer is correct?
So we cannot tell in the reducing balance method. In the straight line method, because the charge is linear, this gets into complicated maths, but you don't need to worry about that. In the straight line method, we actually can tell if we add all things up, they will add up to the total cost that we paid in the start, right? In reducing balance method, that will hardly be the case. But it is extremely simple, right? Straight line method that is also very simple, but reducing balance, you just have to calculate a percentage. You don't need to worry about scrap values and estimated lives or anything like that. You have a percentage given. You take, if it is the first year, you take the cost, you multiply it by that percentage, you arrive at a depreciation. And then if it is the second year, then you take the net book value, which was at the end of the year 1, and then you charge the percentage on that. So that is why we cannot get that sort of check in reducing balance method. That's not possible here.
Okay, sir.
Okay, good. And then the revaluation method, which is the third method, you will hardly ever come across it. And if you ever do come across it, revaluation method, what you need to know about revaluation method is usually depreciation is charged on loose tools, right? Loose tools for usually charge and loose tools usually. So what are loose tools like? There are little tools which are available. For example, if you have a car manufacturing shop, so little tools like screwdrivers or hammers, these sorts of things, obviously they last you for more than 1 year, right? These things last you for 5, 6, 7 years. So they are part of non-current assets, but we call them loose tools. And the good thing about this is that you will be given information something like this, that let's say that the opening value of tools were let's say $10,000. Okay, then they will tell you we purchased some tools during the year, and that was for $3,000. And they will also tell you that the closing value of the loose tools was, for example, let's say $9,000. Okay, so they will give you this information within the question, and they will ask you to calculate the depreciation for the year. So this is very simple. You will take the opening value, which is $10,000, right? Any purchases that you make during the year, obviously they will increase the value of the assets. If you sell anything within the year, that will decrease the value of asset. So we have not sold anything, right? So this will be zero. And then you also have to subtract the depreciation, and then you arrive at the closing value. This is the formula. Okay, so opening value plus purchase of equipment, purchase of tools if there was any, minus sale of tools if there is any, minus depreciation on tools, and you arrive at the closing value for tools. So you just solve this mathematically. So we have 10,000 plus 3,000, we have 13,000, minus 0, because obviously we have not sold anything, minus depreciation is equal to, we also have the closing value, which is 9,000. We take this 9,000 and move all those things there. So 13,000 minus 0 will be 13,000. Minus, we move this here, we get 9,000. And we move depreciation here. So the depreciation for the year would be 13,000 minus 9,000, 4,000. Is this clear? Is this clear, Zan, or any questions?
Yes, sir, I'm clear.
Okay, so then usually in 85 to 90% of the times, usually you will always have to do the straight line method and the reducing balance method. And sometimes maybe for 2 marks or for 1 mark or for maybe 3 marks, but not more than that. You might be given a very small part for evaluation method in which you will be given information like this, and you will have to calculate it. Right? Ren, can you hear me?
Yes, sir, I can hear you.
Yeah. So then this was the major thing. Another thing which I would really want to discuss before we end today's session is the accounting entries that we do for this. So this is very, very simple accounting treatment. First of all, you calculate the thing, and then you need to understand how we treat depreciation in accounting. So we talked about two things. First is depreciation for the year, and then we have accumulated depreciation. So you need to worry about just these two things. Depreciation for the year impacts your income statement. That's one thing that you need to understand. Accumulated depreciation impacts your balance sheet. Okay, so that's the first thing. And we'll talk about how these impact the income statement and the balance sheet. And the second thing that you need to understand is what accounting entry do we pass to record depreciation? It is extremely simple. For example, this depreciation is treated as an expense in the income, which is why it is going to the income statement. So remember, whenever expenses increase, we debit, right? Whenever expenses decrease, we credit. So remember this, right, from the first class then, the treatment for accounting.
Yes, sir.
Yeah. So depreciation is an expense. So depreciation, when it increases, we debit it by whatever amount, and accumulated depreciation will be credited by that amount as well. This is the accounting entry, which you need to absolutely understand that this is what we pass in order to record depreciation. And I'll also show you, for example, when we're making the income statement. Actually, Zan, we'll get to this in the next class because I have another class in just 2 minutes. So far we have gone through what is depreciation, why do we charge depreciation. We've also understood what non-current assets are. We've also understood the three ways in which we calculate the depreciation. We have done 2, 3, 4 examples for every single type. We also understand what is the depreciation schedule, and we also understand the entry, the accounting treatment that we do for depreciation. And we will discuss this further in the next class. So are we good, Zan? Any confusion with regards to this so far that we've discussed?
Sir, I have a question. Uh,
Yes.
when depreciation decreases, so accumulated depreciation will increase. No, like it will go to debit side.
Accumulated depreciation, first of
No,
all, depreciation. Yeah, please.
no,
Go
like
ahead.
here it's increasing, so the accumulated one is going to credit. So if the accumulator is in debit side, so depreciation will be credit side.
No, that will never happen. The thing is then that depreciation, whenever, for example, in year one, you charge 10,000, right? So your depreciation is increasing and your total depreciation is also increasing, right? In year
Yes.
two, for example, you charge 11,000. So again, your depreciation is increasing and your accumulated depreciation is also increasing. In year
Oh,
three, right, you charge, for example, 8,000.
okay.
So in this year, your depreciation expense is increasing because this is done and dusted. Last year is gone. This year, your depreciation was zero, and at the end of the year, it became 8,000. And your accumulated depreciation was 10,000 at the end of year one. It was 21,000 at the end of year two, right? 10,000 plus 11,000. At the end of year three, your accumulated depreciation is 29,000, right?
Okay.
So accumulate doesn't matter if the depreciation expense itself is falling, the accumulated will always be increasing. Hence, we will always put the accumulated depreciation in the credit side.
Okay, sir.
Make sense?
Okay, sir.
Yeah, you go through the reading, Zen, and you look at the examples,
Okay.
and also try to do the examples that we have done, and yeah, you will be able to better understand it. Don't leave any examples from the books. Every single question that from all the chapters that we have discussed, you should be able to do. If you're not able to do, you can come to the class and we can tell you.
Okay, sir.
Okay. So in the next class, we will discuss disposals and we will discuss this accounting treatment, and then we'll move on to trial balance. So this is the last topic that we need to do before we get to the trial balance, and then we'll move to the income statements and balance sheets.
Okay, sir.
All right, then see you tomorrow, same time.
Okay. Assalamualaikum, sir.
Oh, okay. Well,